Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's Annuity Agent, licensed in all 50 states. We have a repeat guest on today because he is the, in my opinion, #1 expert in life insurance in the country, has over 40 years of experience. Yes, that's a 40. Yes, that's 4 decades. If you're buying life insurance from anyone else, please ask them how many decades they have under their belt. His name is Bill Black. He's a personal friend of mine. He's one of the few people in the financial business that's actually taller than I am. He's like 6'8". I'm 6'6". Between the two of us, when we used to speak, it used to be an event. It was like a WWF event. But we always used to tell people we see things better because we're taller. And I think that's true. But welcome back to Fun with Annuities, Bill Black, superstar.
Thank you for having me, Stan. I appreciate it. Glad
for you to be back. Now, we were talking the other day, kind of off the record, and I was, asking you about your triathlete stuff. He's a competitive triathlete, and I want to welcome everybody on the major podcast platforms. If you're not seeing Bill, he's svelte, he's in shape. For the people on the Fun with Annuities YouTube channel, you can see that he's in shape, but he is a competitive dude. And while we were talking about that, I said, well, tell me kind of what's new in the life insurance industry, because he is the sole person I send people that are clients of mine or people that aren't clients of mine that ask about life insurance. Listen, talk to Bill. Tell me, Bill Black, what's new in life insurance for the people out there.
Well, it's interesting that you say that, Stan. I was thinking the other day about our iPhones, right? Or I guess our phones. Most people, it seems like, have iPhones.
Sure.
But, if you look at the younger generation, nobody's
using their phone. What does that mean, Bill? What does that mean to old dudes like us? What does that mean?
Well, what's coming back around again on those streaming channels is Clueless. Remember that when she was in high school in Beverly?
Sure.
Anyway, so like the teenagers and the 20-somethings and even the 30 or 40, even us, right, in the 50, 60-somethings.
Right. Mm-hmm.
People aren't using their phones today for talking. What are they using them for? Email, checking the weather. What else are you doing, right? You're listening to music. You got your music on there.
Checking the stocks, man. Checking the ups and downs.
Exactly. You got apps that do everything for you. Oh, and every now and then you'll make a phone call. Well, life insurance has kind of gone the same way.
Yeah.
People are not really buying life insurance for death benefits so much. And if you talk to an actuary, they say, most people don't think they're ever going to die. And they do know.
Tell them you're saying, Bill. I got to stop you. One out of one of
us is going to not get out of this world, right?
How about that, Tony Robbins? Yeah. Take that, Tony Robbins, you motivational speaker, you. That's Bill Black bringing it. Go ahead, Bill.
But what happens is you almost got to ask yourself today, oh, you've got life insurance? Do you have the old kind or do you have the new kind? And people go, well, what do you mean by that? Well, when you have the old kind, you pay a premium, and when you pass away, they pay the claim. Okay. But then you start to think about people that don't think they're going to die or don't think they're going to die anytime soon.
Right.
We all know people like our grandmothers, our parents, et cetera, that have to have long-term care.
Mm-hmm.
And now what happens is you're using long-term care as life insurance and vice versa. Well, how?
Right.
So I've got a client right now that let their life insurance lapse. And he said, I let my life insurance lapse, but I need some insurance. And so we started talking. The other thing that we don't have is long-term care. The percentage of the people that are going to need long-term care is somewhere around 60 to 70% of us, right? What's long-term care? You can't do 2 out of the 5, 6 activities of daily living.
What are those, Bill? What are those, Bill?
You can't feed yourself. You can't bathe yourself. You can't transport yourself. You can't dress yourself, right?
What's transport?
Get yourself up out of the chair and walk across the room, right?
Transport. And hey, if you can't do 2 of the 6, can we just come to the conclusion, Bill, that life sucks a little bit?
It is a rough thing, right? And so what are you going to do? Well, money solves a lot of problems. And so in this particular case, we said, you know what, we're going to need to live in a nice facility. I mean, my mother, right? She could get around like anything, and she was like 95,
Nice.
and she had to have some radiation on her leg because she had these things that kept coming up. They over-radiated her. They over-radiated her to the point where I won't get into the gore, but she had to
Please
go to
don't.
a facility.
Okay.
That cost her $9,000 a month, and she didn't have long-term care, and she was paying for it out of pocket.
That'd be 300 a day for all you mathematicians out there.
It was a lot of money. So for this particular client, we said, look, don't buy a long-term care policy. Why? Because on a long-term care standalone policy, if you don't use it, you've lost that money, number one. But number two, on a long-term care standalone policy where all it covers is long-term care, they can come back and raise the rates on you or lower the benefits. That's not a good deal, particularly if they're going to lower the benefits on you. Cost of long-term care just goes up every year. You're not gaining any ground.
Absolutely.
So for this client, we crafted a benefit where this policy will pay him $10,000 a month, and that is income tax free for 50 months. Now, most people only last in long-term care 3 years. So that's $360,000. Well, if you're paying for $10,000 a month for 50 months, that's $500,000. If you never use the long-term care benefit, they pay $500,000 income tax-free to your heirs. If you use $200,000 of the long-term care benefits, they pay $300,000 to your heirs.
So it's a life insurance chassis. The long-term care benefit is tax-free, and the death benefit to the beneficiaries is tax-free. What am I missing, Bill? It sounds good.
So what happens is this is a way to cover, and so this is where I'm talking about nobody's using the phone for making phone calls anymore. This is we're using a life insurance chassis to make sure we get long-term care without having to have prices increased, without having to have benefits increased, with knowing that I'm going to get what I pay for. Because if I never use the long-term care, it all goes to my heirs income tax-free as a life insurance benefit. If I do use it, but don't use it all, the difference goes to my heirs as a long-term, as a life insurance benefit. So I'm getting all of my, I know upfront what I'm paying for and what I'm getting, and if I don't get it, my beneficiaries are getting it. So no money is left on the table. The other thing is you're never going to pay in premiums what you're going to get back in long-term care benefits, much less long-term care and survivors benefit.
Right.
So that's really the key is, chances are, and here's the big myth. Medicare is going to cover long-term care. No, it's not. No, it's not. And I have a lot of people that believe that, and then you got to send them the site off of the Medicare website that says we don't cover long-term care. Yeah, they might cover it for 90 days,
right?
But that's what, nothing, right? So this is a big thing. Now, another reason that people use life insurance is liquidity. So there was one particular client who the wife came to me and she said, I had a broker, and my husband is worth $20 million. And when he died, I said, well, where's the life insurance? And she said, the broker said to me, what do you mean life insurance? You're worth $20 million. I told your husband he didn't need it.
Oh,
well, think about a balance sheet, right?
Oh,
a lot of that is tied up in real estate
sure.
and illiquid assets. So life insurance is liquidity. And so for clients that want to leave their spouse or somebody, a certain amount of what? Income, typically, because we have
Sure.
bills.
Sure.
And so what you do is you work backwards into it. How much does the spouse need in particular income? And then we decide how much life insurance is necessary to provide that income stream. So you're not really buying it for the survivor's benefit as
Right.
a lump sum. You're buying it for the cash monthly income to replace income. Because a lot of times when the client dies, the spouse isn't necessarily able to generate the same income. And people, have their home, their vacation home, et cetera, et cetera. All those assets call for cash every month. Let's replace that income. And that's another reason. So we're really using life insurance as an income
Sure.
generation tool in this case, as opposed to the thing. Now, the third thing people use life insurance for is term insurance, right? And it's kind of like when I went back to the thing earlier is do you have the old type of insurance or the new type of insurance?
Sure.
The old type of term insurance was called ART, or annual renewable term, where you paid a razor thin premium in year one. It went up more in year two, up
Sure.
higher every year it went up. And okay, people didn't like that, so they came out with level premium insurance. Love
Right.
it. 10-year level premium, 15-year, 20-year level premium. Only problem is, and this a couple of clients that you've referred to me are at the end of that level period. So what happens? That premium goes through the roof at the end of the level period.
So what do you do, Bill Black? What do you do
So
for those people?
you get it with new type of insurance where you have temporary term or what I call permanent term.
Mhm.
And what the heck do I mean permanent term? If you have a policy that's temporary term, it's got a premium that's level for 10 years, 15 years, or 20 years,
Sure.
or even 30 years in some cases.
Okay.
But if you're 40 years old and you buy a 30-year level term policy, at 70, you're out of
Yeah.
insurance. You can actually buy these policies now that guarantee the premium until you're 100, 105, 110 years old. And it's basically term insurance. You pay a thin premium. You're not building any cash value. You're
Sure.
buying the protection. But these are guaranteed. The company can't come back and raise the rate on you or cut the coverage for you.
Mhm.
And so if you think about it logically, if you buy a 20-year level term premium, you're going to pay more than if you buy a 10-year level term premium,
Sure.
right? Sure.
Absolutely.
If you buy a 30-year level premium, you're going to pay more than if you buy a 20-year level term premium. Well, if you buy a premium that's level until you're 100, it's, as I call it, term to 100, you're going to pay more for that than you are a 30-year term. But what are you doing? It's permanent term. It is a razor thin premium. You're not building cash value. You're paying for the protection, and it's locked in and guaranteed until that point in the future. Now, here's a crazy part. I can guarantee it till you're 120 years of age. I tell a client, I think we're overpaying if we guarantee it to 120, right? So let's look at something that's more realistic. Let's look at family history, right? Because that's a big indication of what our
Sure.
life expectancy is. So if we've got parents that are not living past 85, okay, maybe we want to keep the insurance so we're, guaranteed to 90, 95. I kind of use 100 as a starting point because some of these billboards out there that says the first person that's going to live to 125 has already been born. I don't know about you. I don't think I want to live to 125.
No, that's not going to be
Yeah.
pretty.
Right. But at the same time, these are the tools that are there. And the thing that happens for the most part, and I say the most part, I'm going to say 85 to 95% of the time, is you want to buy life insurance for the protection, to protect your heirs, your financial needs. Okay, taxes. A lot of times when we pass away, there are taxes that are due. Death taxes, as some people call them, inheritance taxes, estate taxes.
Sure.
They used to cost us 55 cents on every dollar we had over $1 million. Now they
Mhm.
changed that, okay, and now it's tens of millions before we pay estate taxes. But there's a lot of talk about when that sunsets, they're going to bring the estate tax back,
They will.
and so another tool that life insurance covers is paying the tax. Now that's another reason to have life insurance, is because particularly, as we were talking a moment ago, the very wealthy don't have it all in liquid assets. They have it in farmland. They have it in commercial buildings. They have it in
Correct.
other investments. And okay, if the real estate market is up when we pass away, or the stock market's up and we can liquidate it, okay. But this is cash, those estate taxes are due in cash in 9 months. And so life insurance is the easiest way to buy it or pay those taxes. And again, I'll talk to a client and say, let's say for every $1 million worth of insurance you're buying to pay estate taxes. If you don't buy it, that's okay. When we pass away, our heirs have to come up with $1 million cash within 90 days. What if I told you that I could have you pay 40 cents on the dollar instead of the million, pay 400,000, maybe less? And instead of paying it all upfront in cash, spread that out over 10, 15, 20, 30 years. What would you rather do? Well, I'd rather pay 40 cents on the dollar and spread the cost out over 30 years. Exactly. And that's what insurance does. You're never going to pay in premium what you're going to pay in taxes or the survivor's benefit. And you're going to pay that premium over a shorter or a longer period of time. So that that 40% that you pay in premium, you're going to pay out over a short. And so tell me the day you're going to die. I'll tell you the best way to do it. Right. And so this is the really thing we're looking at is cost benefit ratio. I'd rather pay a couple of, 2, 3, 4% a year every year and pay 40 cents on the dollar rather than pay 100 cents on the dollar. So that's another reason, to use life insurance.
And ladies and gentlemen, we are talking to Bill Black, in my opinion, the top expert in life insurance in the country. There can't be many more people with his type of experience over 40 years. What's the actual year, Bill? It's 44 or something.
40. Yeah, it's going to be 44 next January.
44 years of experience next January.
Yeah,
He has forgotten
hard
more
to
than
believe.
most life insurance people will ever know in their lifetime. We'll have his contact information on the site as we always do. You can contact him direct. He is like me. He's an absolute straight shooter and truth teller. He has a fantastic staff, concierge service, first class, start to finish. There's no high pressure. What you're hearing from Bill and the cadence of the way he talks and presents is exactly how it will be when you call him. So if you hesitate to call, you're making a mistake. I would encourage you, if you have a life insurance policy of any type, let him review it. Let him see if there's any way to mathematically and contractually upgrade you. He'll tell you if you can't, and he'll tell you how to make lemonade if you can't get out of it. But he is my go-to source for all things life insurance. And I think he's talking about a subject that all of us need to think about is long-term care. But the other thing Bill mentions to me all the time is, life insurance is the best return on investment you'll never see. I use that all the time. So Stan, that's witty. No, that's Bill Black. That's what Bill Black told me a long time ago. It's the best ROI you can ever get on any investment. Problem is you're going to be dead, and death is not a good strategy. Am I correct, Bill?
Oh, that's true. We'd like to stay around as long as possible. It's just not going to happen.
Death is a one-time strategy, so maximize it, right? But that's why we need Bill Black. So when your Learjet does hit the mountain, you've covered the income needs for your heirs. You've covered the taxes for your heirs. It's a lump sum tax-free and keyword probate-free transfer of wealth. And this is it's not throwing money down a rabbit hole. Life insurance, I love life insurance. I have a ton of myself. So if my daughters, if you see them, racing their dual Lamborghinis down I-95, that they offed me, and so you might want to turn them in. But my family is going to benefit from life insurance, and I credit Bill Black because he hit me over the head with it for so many years, and I listened to his presentations, and he is 100% correct. What are you seeing out there, Bill, with the Fed raising rates? Tell the people how Chairman Powell, time of this taping, Chairman Powell is running the Fed, and Miss Yellen's squawking in the background. How is that affecting positive or negative life insurance products?
Well, there's a couple of things that have happened. So we're starting to see interest rates rise, and some of our policies that clients have are dividend paying whole life policies. Now they pay a dividend, and those dividends look wonderful in a falling interest rate environment. What? Of course. Why? Because what does an insurance company do, right? They take your premiums, they invest them in bonds, and those bonds, a typical bond has a 30-year maturity, and we have what is called a laddered bond portfolio, where bonds are coming due every year, right? And the bonds they bought 30 years ago were coming due now. Well, when they bought those bonds, every time they renewed them and had to reinvest them as interest rates were dropping, but still their blended rate was higher because, they're investing some at a lower rate today, but they still have some older bonds that had a higher rate. And so you would see dividends that might be 4, 4.5%, 5%. Look good when interest rates were zero. Now, as interest rates are starting to climb to 4, 5, 6%, they still have those old bonds on the books that they were buying at the lower rates. So it's going to take them longer to crawl out of that hole. So these dividend paying whole life policies, their dividends aren't going to look so great anymore. And so what's happening is the newer type of policies, right? Going back to you got the old type or the new type, are actually tied to the index. The Standard & Poor's 500 is a typical index in which it's tied. So if the market goes up, you participate in that gain. If the market goes down, you don't take a loss. You just are even with the board. And so those are called indexed policies. And people say, well, how can they do that without, it's kind of beyond the scope of this podcast, but they do it with options. So instead of crediting you interest, they buy
Sure.
options on the market.
Similar to indexed annuities, but
yeah, right.
a little bit more complex.
Yeah. And so this is what's happening. And then when you look at the stock market historically, okay, we got beaten up yesterday. Okay, we got beaten up all this year. The worst a client's going to do in that environment is stay even with the board.
Sure.
When the market goes up, they're going to get a gain. And so people are starting to say, you know what? Really, long term, the market outperforms these 4 and 5% returns. Why don't we start using these index type of policies?
But what's the
Buy 'em with
downside?
guarantees.
Can't the life insurance company change the rules? Wouldn't the policy fees eat that up in some cases?
Yeah. So one of the things that happens is life insurance is a little bit complex because life insurance isn't free. There's a cost of the insurance, there's a cost of administration, et cetera. So when you buy the policy, you have to sign what is called a compliance ledger. On that ledger, they have a set of tables that's called the guaranteed. That is your worst case scenario. So assuming they charged you the maximum cost of insurance from the very first day that policy was purchased, and they credited you the least amount of return they could on that policy, how does it look? That is what you want to make sure lasts until 100 years of age or whatever your target was, like we're talking a moment ago, age 95, age 125, age 100, whatever. As long as it's guaranteed, the rest of it is just gravy if you get more than that. So when the market does perform better than zero, those earnings are going to be credited to you.
Sure.
And you're going to end up being okay. So that's really what you want to look at. Like any business decision, what's the worst I can do? If I can live with that, everything else is fine. So these are the type of things you want to look at. In fact, one of your referrals, they sent me their policy. The guaranteeds ran out at age 83. Sorry, that's before life expectancy.
Sure.
And so what we're doing is we're bringing that to higher ground where we guarantee the worst case scenario to age 100. Everything else is just, gravy. And it will, in my opinion, perform better than the minimum worst case scenario. But if it doesn't, they still have coverage until.
I'm going to tell you, I have been doing this a long time. I have referred Bill so many people. I have yet to have one person say that was a bad experience. He is the best. Can you walk, they're going to talk to you, they're going to call you, they're going to send you their policies, and then they say to you, Bill, let's move forward. Can you kind of walk through from a 30,000-foot view what that process looks like for people? I don't want people to think this is this you're not going to plop a bunch of paperwork in front of them. Tell the listeners and viewers how that works with your organization and the best staff on the planet in life insurance. How does that work?
So there's two ways it works. If we're going to buy term insurance, there's a simplified process now where we get a little bit of information, you sign off on it, and then the insurance company, that gives the insurance company their authorization to call you, gather your information, gather your medical records, order the exam. The exam is done and scheduled at a time and place convenient to you and paid for by the insurance company. So you sign off on a ticket, as we call it. Then the insurance company calls you, asks you all the health questions, gets your doctor information, all the doctors you've seen in the last 5 years, gathers your medical records, does the analysis, and then comes back to you with the offer. If it's a more permanent type of a policy, then there is an e-application. Everything's electronic today. You just DocuSign it.
Sure.
And then same thing, an exam is scheduled at a time and place convenient to you. They'll come by your house at 8 o'clock on a Saturday morning if you want it, or 5 o'clock in the afternoon, whatever time is good for you. Scheduled through our office, paid for by the insurance company. Gather all of the medical records. And when I say gather, our side of the table gathers all the medical records.
Sure.
And prepays for those to the doctor. You just sign a HIPAA form. Send it all to the insurance company. They do their analysis, and they come back with their offer. The key here is that we don't take any money until we have the policy offer in our possession, we communicate it to you, and you're happy with it. So that way, you don't have any skin in the game.
Beautiful.
You don't have anything on the table. If you're serious, we will run you through the analysis process, and
Sure.
then and only then, if you're happy, do you pay. Now, how do you get paid, Bill? A lot of people tell me, you never pay us. I don't think it's a secret. We get a commission on the sale of the life
Sure.
insurance. That's where we get paid.
Just like annuities, it's built in. Yep.
Yeah,
Absolutely.
that comes out of the premium. So if you pay a premium for every dollar you pay,
Sure.
you know, part of it goes to the cost of the insurance, part of it goes to the
Sure.
acquisition cost, part of it goes to,
Sure.
you know, the reserves for paying future claims, et cetera. It's all baked in. And so
Will
that's
you be
how it goes.
brutally honest with people? I know this answer, but I'm asking you anyway.
Mhm.
Someone can't qualify, dreaming, just can't get there, what's not going to happen. You're going to be brutally honest and not waste their time, correct?
Well, yeah. I mean, we have clients that come to us, and the first thing we do is we, you know, what meds are you on? Do you have any adverse health history,
Sure.
et cetera, et cetera, et cetera? And then, you know, some people come to us and they say, I'm just uninsurable, and we can still get them insured. Some people come to us and say, you know what, I'm uninsurable. And I say, yeah, I think you are. And so it really is a function of, you know, what exactly is the situation. And the reason I say that is we are brokers. We can write any company out there, virtually any company,
Sure.
and not all companies are all things to all people. So one company will look bad on people that are diabetics. Other people will say, oh, well, that's, you know, the A1C levels aren't that bad. Some companies, if you so much as take Nicorette gum, you're a smoker. Other companies will give you a non-tobacco rate as long as it's anything but a cigarette, right? So you can dip, you can smoke a cigar, you can smoke a pipe.
How
They will
about
still give
vaping?
those.
What's vaping doing right now?
Yeah, vaping is still a here's the thing, you're still going to get a non-tobacco rate as long as when you take your exam and they do the, you know, the bodily fluids test,
Sure.
as long as the nicotine is 0. And that's what it's going to be if you smoke like one cigar a week on the golf course or, you know, something
Sure.
like that.
Sure. Yeah.
You're going to get a non-smoker rate, but you got to own up to it. You got to say, yeah, I smoke a cigar, I smoke it, you know,
I
once
vape.
a month.
I go to the club and
Exactly.
vape, and that cool.
Right.
Right.
And even, believe it or not, even marijuana isn't looked at like it used to be. Like, you know,
That
do
doesn't
you
surprise
use
me. That doesn't
this,
surprise
that, and the other? Yeah.
Yeah.
And so, you know, things are getting a little bit more modern, you know, up to date, whatever you want to call it.
Sure.
And so as long as you just disclose it, it's not a problem. It's just not a problem.
So a couple more questions before we kind of close it all out. And I'm so
Mhm.
glad that you joined us. Obviously, we're going to have Bill's information on the site, so you can contact him direct. If you don't want to do that and just call me, then I'll email you his information, whatever it takes. Anything else new out there, Bill, that's in your 40 plus years of experience that's getting your attention?
Yeah, the one thing that's getting my attention is the changes in these interest rates, right? And so what happens is we've had a 0 interest rate environment for a long time.
Mm-hmm.
It's very difficult for anybody to make money in a 0 interest rate environment if your whole business model is a function of investing in interest-bearing securities. And what I mean by that is an insurance company just can't go out and invest the money any way they want to. They are regulated by insurance commissioners. And generally speaking, insurance companies are the ones that buy bond issues,
Sure.
mortgages. You know, this is all interest rate driven stuff, typically not in the stock market because, you know, you have big ups and downs in the market. So because of these recent 0 interest rate environment, a lot of these type of guaranteed policies have actually been pulled by the insurance companies.
Okay.
A lot of insurance companies have merged with other companies. So when I got into this business, we had thousands of companies. There are fewer now, just like the banking industry. And so it becomes a different world to navigate. We used to have term insurance that was convertible. What does that mean? You have term insurance, it's temporary, but you know what? Now I'm uninsurable. Well, I've got this term policy. They will let me turn it in for a permanent policy at the rate classification that the term policy was issued. In other words, you had a term policy that was issued 15 years ago, and now you're uninsurable for whatever reason, they let you convert that term policy to a permanent policy at a preferred rate, at the rate at your current age. That's a big benefit.
Sure.
A lot of term policies today don't have conversion features anymore.
Mm.
So you got to look at this stuff very carefully. It's all a function of zero interest
No,
rate.
people don't have to look at it. They need you to look at it.
Well, there you go.
I mean,
And
they
yeah.
give your policies to Bill and let him review them. And let me tell you, he's gonna, if you have a good policy, he's gonna say, hey, great, you're fine. He's not gonna try to flip everything. I mean, he's just not. He's going to tell you the truth, which is the reason he's on the podcast. One last thing, Bill, because we got to run. Mic drop moment. I do this with every single guest. As you know, you've done it before and you are phenomenal.
Mhm.
So you might be prepared. I don't know. Mic drop moment, Bill Black, and 5, 4, 3, 2, 1, go.
One out of one of us isn't going to get out of here alive. So
Yes.
planning, like anything else, is paramount. If we don't have a plan, there's one for us. It's probably not the one we want.
Yes.
And so the whole thing is to look at this as, what is it that I'm trying to accomplish, and how do I accomplish it at the best price and the best for my family and my set of circumstances. And like anything else, a second opinion is great. Happy to give you a second opinion. And as you
Sure.
said, if something is good, which happened to me the other day, the client sent me something, particularly a term policy.
Sure.
You know what? If you can't get a better price, stay with what you have, and there's no reason to
Absolutely.
change it.
Absolutely.
And a lot of people say to me, well, how did you pick this company? Well, first of all, we won't write a company unless it's A-rated or better.
Sure.
Number one. Number two, because we're brokers, we can look at all the companies and find the best rate based on the client's circumstances. And then when we buy these policies for our client or acquire these policies, there's a lot of things behind the scenes that people just don't think about. 10-year level premium. Well, some companies have a 10-year level premium, but it's only guaranteed for 5 years. Huh? You mean you can raise that rate in the 6th year? Yeah, we won't write those policies. We won't let our
Gotcha.
clients walk away with them. So these are all the little things behind the scenes that are just like traps that, we help navigate that. So you get what you're expecting.
That's exactly right. That's Bill Black. He is the guy when it comes to life insurance. I appreciate him joining us. And I appreciate everyone on all the major podcast platforms that join us every week and on the Fun with Annuities YouTube channel. I will see you next time. Take care.